Did you know that in 2022, taxpayers saved over $1 trillion through various deductions? But how exactly does this massive saving work? In this video, we'll talk about tax deductions, unraveling how they can significantly reduce your taxable income and, consequently, your tax bill. Hit the subscribe button and ring the bell to stay updated with more finance tips and tricks. Let's get started and unlock the secrets of maximizing your tax savings. What does the term tax deductions mean? Tax deductions are certain expenses that the government allows you to subtract from your total income when you calculate how much tax you need to pay. Imagine if you earned $100 and spent $10 on something that the government says is deductible. You only have to pay tax on $90 instead of the full $100. This means you get to keep more of your money because you're taxed on a lower amount. How do tax deductions lower my taxable income? For every business expense, the IRS pledges to pay 40 to 45% of that expense on behalf of the business owner. The remaining 50 to 55% is what the owner himself bears. Therefore, it is the duty of the owner to take into account each and every business expense and show them on his tax return. Now, on your taxes, there are two ways to show your deductions. Number one is known as the standard deduction, and the other way you can take some of your deductions is by itemizing them. So, what's the difference between standard and itemized deductions? The IRS gives you two major choices for lowering your taxable income. Take the standard deduction or itemize. Most taxpayers opt for the standard deduction simply because it's less work than itemizing. The standard deduction for married filing jointly is $29,200, which means if you are filing jointly, you can right away use those amounts to lower your taxable income. Itemized deductions, subject to certain dollar limitations, include amounts you paid during the taxable year for state and local income or sales taxes, real property taxes, personal property taxes, mortgage interest, disaster losses, gifts to charities, and part of the amount you paid for medical and dental expenses. What about tax credits? Are they like deductions? A tax credit is a dollar-for-dollar amount taxpayers claim on their tax return to reduce the income tax they owe. Eligible taxpayers can use them to reduce their tax bill and potentially increase their refund. What are common personal tax deductions? Personal tax deductions are special expenses the government allows you to subtract from your income before calculating how much tax you owe. These can include money given to charities, interest paid on your home loan, costs for school like tuition and books, medical bills that are more than a small part of your income, and certain taxes paid to your state or local government. By subtracting these expenses, your income looks smaller to the tax system, and you end up paying less in taxes. It's like getting a discount on your tax bill for spending money on these important things. What counts as a charitable donation? When you give money or things to a charity, it's called a charitable donation. Not everything you give away can be counted to lower your taxes, though. Only donations to approved organizations count. Also, you need to keep a record, like a receipt, to show how much you gave. Can I deduct my home mortgage interest? Yes, if you borrowed money to buy your house, the interest you pay on that loan can often be deducted. However, there are limits. For most people, if your loan was for buying, building, or improving your home, you can deduct the interest on up to $750,000 of the loan. How about money spent on school? Money spent on college or vocational school can sometimes be deducted. This includes tuition and books, but not all educational expenses like room and board. Keep track of your receipts because not everything is deductible, and there are caps on how much you can deduct. What about medical and dental bills? If you spend a lot of money on medical or dental care, you might be able to deduct some of it. The rule is that only the amount of your total medical expenses that exceeds 7.5% of your income can be deducted. So if you make $40,000 a year, you can only deduct medical expenses that are above $3,000. Can I deduct state and local taxes? Yes, you can deduct some of the taxes you pay to your state or local government. This includes state income tax and property taxes. However, there's a cap of $10,000, $5,000 if married filing separately, on the total amount you can deduct. What are deductions for business and self-employed individuals? If you run your own business or work for yourself, there are special deductions you can take to lower your taxes. This includes money spent on your home office, buying supplies, and travel for work. If you use your car for business, you can deduct some of those costs too. Also, putting money into a retirement account for yourself can lower your taxes. What can I deduct for my home office and supplies? If you work from home, you might be able to deduct expenses for your home office and the supplies you use for work. The space must be used regularly and only for your business. You can deduct things like office supplies, furniture, and even a part of your home's costs, like electricity and internet, based on the size of your office compared to your home. How do I deduct business travel and meals? When you travel for work or have business meals, you can often deduct these costs. For meals to count, they need to be related to your business, and you can usually deduct 50% of the cost. For travel, things like plane tickets, hotel stays, and even some transportation can be deducted if your trip is mainly for business. Can I deduct costs related to using my car for work? Yes, if you use your car for work, you can choose between two ways to deduct expenses: the standard mileage rate or actual expenses. The standard mileage rate lets you deduct a set amount for every mile driven for work. Actual expenses involve adding up all your car-related expenses, like gas, repairs, and insurance, and deducting the portion that's for business use. Did you know there are some tax deductions you might not have heard about? For example, if you moved because of your first job, you might be able to deduct some moving expenses. This includes things like the cost of moving your stuff and traveling to the new place. But there are specific rules about how far your new job is from your old home. Also, if you spent money looking for a new job in the same line of work, some of those costs could be deductible. This can include things like traveling to interviews or paying for job placement services. And for those who have hobbies that make money, like selling handmade crafts, you might be able to deduct some expenses related to your hobby. However, the rule is that you can only deduct costs up to the amount of money you made from the hobby. That wraps up our guide on maximizing your tax deductions, covering everything from well-known to the less familiar deductions that could save you money. Remember, understanding and applying these deductions can make a significant difference in your tax bill, putting more money back in your pocket. If you found this information helpful, please hit the like button, subscribe to our channel for more financial tips, and don't hesitate to share this video with friends and family who could benefit from these tips. Have any questions or experiences with tax deductions you'd like to share? Drop a comment below. We'd love to hear from you. Let's navigate the world of taxes together, making it as easy and beneficial for you as possible. See you in the next video.